What if I told you that every financial crisis you've lived through, from the dot-com crash to the housing meltdown to the chaos of 2020, wasn't just bad luck or the result of a few greedy bankers? What if the crashes were baked into the system from the start, engineered by a financial architecture so complex that even most economists don't understand it, and so profitable for those at the top that they have zero incentive to fix it? Here's what they don't want you to know. Behind every bubble, there's a pattern. Behind every collapse, there's a mechanism. And behind every bailout, there's a network of shadow institutions that operate completely outside the traditional banking system, gambling with money that doesn't even exist, creating phantom wealth that vanishes the moment anyone asks to see the receipts. You feel it right now, don't you? The credit card bills that never seem to shrink, the mortgage payments that eat half your paycheck, the nagging sense that no matter how hard you work, you're falling further behind. That's not your failure. That's the system working exactly as designed. So before we dive into the machinery of madness, drop a comment and tell me where you're watching from. And if you are ready for the unfiltered truth about how modern finance turned into the largest casino in human history, hit that subscribe button. Because what I am about to show you will change how you see every news headline about market crashes, bank failures, and economic recovery. Let's pull back the curtain. To understand where we're headed, we need to look at where we've been. And the history of financial bubbles is really the history of the same scam, repeated over and over, each time with better marketing and more complex mathematics. Take the Dutch tulip mania of 1637. Everyone knows the story, right? Tulip bulbs became so valuable that people were trading their houses for a single flower. Then reality hit, prices collapsed, and fortunes evaporated overnight. But here's what they don't teach you in economics class. It wasn't just stupidity. It was leveraged speculation enabled by informal credit networks. Traders weren't buying tulips with cash. They were buying with promises, with contracts, with derivatives of derivatives. By the time the music stopped, the amount of money promised in tulip contracts was 10 times larger than the actual money in circulation. Sound familiar? Fast forward to the South Sea bubble of 1720. The South Sea Company convinced the British government to let them take over the national debt in exchange for a monopoly on trade with South America. The stock price went from £100 to over £1,000 in less than a year. Members of Parliament, the aristocracy, even Isaac Newton himself poured money in. Newton famously said he could calculate the motion of heavenly bodies, but not the madness of crowds. He lost the equivalent of £3 million in today's money. But here's the part they skip. The South Sea Company didn't just inflate their stock through hype. They created an entire ecosystem of bubble companies. Hundreds of shell corporations offering shares in ventures that didn't exist. One company literally promised to create perpetual motion machines. Another offered shares in a company whose business plan was, quote, a company for carrying out an undertaking of great advantage, but nobody to know what it is, unquote. And investors threw money at all of it, because the market was going up and nobody wanted to miss out. Sound familiar? Now jump to the roaring 20s. The stock market became the national obsession. Ordinary people were buying stocks on margin, meaning they only put down 10% of the purchase price and borrowed the rest from their broker. Banks were speculating with depositor money. Investment trusts, the mutual funds of their day, were leveraging themselves at ratios of 20 to 1. By 1929, the total value of all stocks was 3 times the actual productive output of the American economy. When Black Tuesday hit on October 29, 1929, 16 million shares were traded in a single day. The market lost $14 billion in value, equivalent to over $200 billion today. But the crash didn't cause the Great Depression by itself. What caused the depression was the realization that all that wealth, all those stock certificates, all those investment trusts, represented nothing real. The money had been fictional all along. Sound familiar? Because here's where it gets really interesting. After the Great Depression, governments around the world said never again. They created regulations, They separated commercial banking from investment banking through the Glass-Steagall Act. They created the Securities and Exchange Commission to watch over markets. They built a system designed to prevent exactly this kind of speculative mania. And for about 50 years, it worked. Sure, there were recessions and corrections, but nothing like the systemic collapses of the past. The financial sector was boring. Banks made loans, collected interest, and went home at 5 p.m. Wall Street employed less than 5% of college graduates. Then something changed. In the 1970s, a new breed of financial engineers started asking a question. What if we could take risk itself and turn it into a product? What if we could slice it, package it, and sell it? What if we could create financial instruments so complex that they required PhD mathematicians to price them? And so they did. They created derivatives. Financial contracts whose value derives from the performance of an underlying asset. Stock options, currency futures, interest rate swaps, credit default swaps, collateralized debt obligations, synthetic collateralized debt obligations. By the 1990s, the derivatives market had grown larger than the entire global economy. By the 2000s, it was 10 times larger. Today, conservative estimates put the notional value of the global derivatives market at over $600 trillion. That's 12 times the size of the entire world economy. 12 times the value of every factory, every house, every bushel of wheat, every car, every anything that actually exists in the physical world. Think about that. We have created a financial system where phantom bets on the future value of things are 12 times larger than all the real things combined. And most of these derivatives don't trade on public exchanges. They trade in what's called the over-the-counter market. Private deals between institutions. No transparency, no oversight, no centralized clearinghouse to tell you who owes what to whom. This is the shadow banking system. And it's not a conspiracy theory. It's the technical term used by economists and regulators. Shadow banks are financial institutions that everything traditional banks do, lending money, creating credit, facilitating transactions, but they operate outside the regulatory framework designed to keep traditional banks safe. They include hedge funds, private equity firms, money market funds, insurance companies that sell credit protection, special purpose vehicles created to hold securitized loans, and the trading desks of major investment banks. And here's the kicker. When Glass-Steagall was repealed in 1999, the wall between commercial banking and investment banking came down. The boring banks that held your checking account merged with the casinos. Your deposits became the chips in their game. Now, you might be thinking, okay, derivatives sound risky. But surely someone's watching this, right? Surely after 2008, when the housing market collapsed and nearly took down the entire global financial system, surely they fixed this. Here's where the story gets darker. There was a moment, a single moment in time, when someone tried to pull the emergency brake. Her name was Brooksley Born, and in 1998 she was the head of the Commodity Futures Trading Commission. She saw the derivatives market exploding and recognized it for what it was, a nuclear bomb sitting in the middle of the financial system. She tried to regulate it. She issued a concept release asking whether derivatives should be subject to oversight. The reaction from the most powerful men in finance was swift and brutal. Alan Greenspan, chairman of the Federal Reserve, Robert Rubin, Treasury Secretary, Larry Summers, Rubin's deputy, they all told her to back off. They called her proposals catastrophic. They said derivatives were too complex and too important to touch. Congress passed a law specifically preventing her agency from regulating derivatives. Born resigned in 1999. 9 years later, the unregulated derivatives market imploded, triggering the 2008 financial crisis, just as she predicted. But here's the part that should terrify you. After the crisis, after the bailouts, after the public outrage, what changed? The Dodd-Frank Act passed in 2010. Supposedly the Great Reform. But the derivatives market? Still largely unregulated, still trading in shadows. And now, it's even bigger, because the people who crashed the system in 2008, they're still in charge. Some of them got promoted, and the mechanism that allowed them to turn subprime mortgages into AAA-rated securities that exploded and nearly destroyed civilization. That machinery is still running. You won't believe the name of the credit rating agency that blessed those toxic securities as safe investments, took payment from the same banks creating them, and faced zero criminal prosecution. The receipt is wilder than you think. Let's break down exactly how this machine works, because understanding the mechanism is the only way to see the crash coming before it arrives. It starts with something called securitization. In the old days, when you took out a mortgage, your local bank held that loan. If you defaulted, they lost money. So they cared whether you could actually afford the house. They had skin in the game. But in the new model, the bank doesn't hold your mortgage. The day after you sign, they sell it to an investment bank. That investment bank bundles your mortgage with thousands of others into a mortgage-backed security. They slice that security into tranches, different layers with different levels of risk and return. The top tranche gets paid first and is supposedly the safest. The bottom tranche, called the equity tranche, takes the first losses but promises higher returns. Here's where it gets insane. They take those mortgage-backed securities and use them as collateral to create another layer of securities. These are called collateralized debt obligations, or CDOs. And then they create synthetic CDOs, which are basically bets on the performance of the real CDOs. You can create unlimited synthetic versions. The same mortgage, the same family making payments on their home in Ohio, can be referenced in dozens of different synthetic securities. By 2007, Wall Street had turned about $1.5 trillion of actual mortgages into approximately $20 trillion of mortgage-related securities and derivatives. They multiplied the risk by a factor of more than 10. Now, for this scheme to work, someone has to vouch that these securities are safe. Enter the credit rating agencies: Moody's, Standard & Poor's, Fitch. These companies rate the risk of bonds and securities. AAA is the safest, the same rating as U.S. Treasury bonds. In the lead up to 2008, these agencies gave AAA ratings to mortgage-backed securities that were filled with subprime loans, loans given to people with terrible credit, no income verification, and no down payment. Why? Because the investment banks creating the securities paid the rating agencies to rate them. It's like a student paying a teacher to grade their test. The incentive to be honest disappears. Internal emails from rating agencies, released later, showed analysts joking about how the securities could be structured by cows and still get approved. One Standard & Poor's analyst wrote that the system was a machine that turned lead into gold. Another wrote that they sold their soul to the devil for revenue. But the rating mattered because pension funds, insurance companies, and foreign banks are often required by law to only buy highly rated securities. So when something had a AAA stamp, institutions around the world bought it without asking questions. They trusted the system. By 2006, over 8% of mortgage-backed securities were receiving AAA ratings. More AAA-rated paper was being created from subprime mortgages than from all the U.S. Treasury bonds in existence. Now, let's talk about leverage, because this is where the shadow banking system becomes a doomsday device. Leverage means borrowing money to amplify your bets. If you have $1 million and you borrow $9 million more, you now control $10 million. If your investment goes up 10%, you've doubled your original million. But if it goes down 10%, you've lost everything. Traditional banks are subject to capital requirements. They have to hold a certain amount of safe capital relative to their risky assets. This limits how much they can leverage. But shadow banks, investment banks, hedge funds, they operated under different rules. Bear Stearns had a leverage ratio of 35-1 when it collapsed. Lehman Brothers was over 30-1. Fannie Mae and Freddie Mac, the government-sponsored mortgage giants, were leveraged at 75-1. That means for every $75 they had in assets, they only had $1 of actual capital. A tiny decline in asset values, and they were insolvent. And here's the truly demonic part. Many of these institutions borrowed money overnight in what's called the repo market. Repo is short for repurchase agreement. You post collateral, borrow cash overnight, and promised to buy back the collateral the next day at a slightly higher price. It's like a pawn shop for banks. But this overnight funding created a terrifying fragility. If lenders lost confidence, even for a day, the bank couldn't roll over its debt and would face immediate collapse. This is exactly what happened to Lehman Brothers in September 2008. The repo market froze, the overnight money disappeared, and the bank went from solvent to bankrupt in 72 hours. The collapse of Lehman triggered a panic in the shadow banking system. Nobody knew who owed what to whom. Everyone stopped lending. The commercial paper market, where corporations borrow for day-to-day operations, froze. Money market funds, which ordinary people thought were as safe as bank accounts, started breaking the buck, meaning they couldn't guarantee $1 for every dollar invested. Within weeks, global credit markets were on the verge of complete shutdown. The Federal Reserve had to create emergency lending facilities with Orwellian names like the Term Auction Facility and the Commercial Paper Funding Facility. They lent over $7.7 trillion to banks and corporations, often in secret. The word bailout became a curse. But here's what most people missed. The bailouts weren't just about rescuing banks. They were about rescuing the shadow banking system and the derivatives market that sat on top of it. Because the biggest banks weren't just lending institutions. They were the central nodes in a web of interconnected derivatives contracts. AIG, the insurance giant, had sold over $500 billion worth of credit default swaps, essentially insurance policies on mortgage-backed securities. When those securities started failing, AIG was on the hook for massive payouts. But AIG didn't have the money. If AIG failed, every bank that had bought protection from them would also face losses. The entire chain would collapse. So the government gave AIG $182 billion, and AIG used that money to pay off the banks on the other side of those derivatives contracts. Goldman Sachs alone received $12.9 billion through the AIG backdoor bailout, not because they needed it to survive. Goldman claimed they were fully hedged, but because the system had become so interconnected that letting any piece fail risked bringing down the whole structure. This is what too big to fail really means. Not that individual banks are too important, but that the shadow banking network has become so tangled, so leveraged, so derivative dependent, that the failure of any major node creates cascading collapse. And what did we learn? Apparently nothing. Today, the derivatives market is bigger than ever. The Bank for International Settlements, the central bank for central banks, reported that the notional value of over-the-counter derivatives was over $630 trillion as of the end of 2023. JP Morgan Chase alone holds derivatives with a notional value over $54 trillion. That's more than twice the size of the entire US economy, held by one bank. And these aren't hedges against real-world risk. Most are speculative bets. They're synthetic positions on top of synthetic positions. They exist only on spreadsheets and in computer servers. But when they unwind, the losses are very real. The Volcker Rule, part of Dodd-Frank, was supposed to prevent banks from making risky proprietary trades. But it was watered down by industry lobbying. Banks can still trade derivatives for market making, a loophole you could drive a truck through. The shadow banking system, meanwhile, has just migrated to new forms. Private equity now manages over $12 trillion in assets. Private credit funds, which make loans outside the traditional banking system, have exploded to over $1.6 trillion. These funds operate with even less transparency than the pre-crisis shadow banks. And we're seeing the same patterns. Covenant-light loans, meaning loans with fewer protections for lenders, made up over 80% of the leveraged loan market in 2023. Companies are borrowing at valuations and leverage ratios that would have been unthinkable before 2008. The parallel to the housing bubble is exact. Low interest rates for over a decade, thanks to central bank policy, created a hunt for yield. Investors desperate for returns poured money into riskier and riskier assets. Private equity firms borrowed billions to buy companies at inflated prices. The value of leveraged buyouts reached over $1 trillion in 2021. Just like the mortgage lenders who gave loans to anyone with a pulse, These firms are loading companies with unsustainable debt. And just like the investment banks that securitize those mortgages, private equity firms package and resell that debt through collateralized loan obligations, CLOs. The CLO market is now worth over $1 trillion. History doesn't repeat, but it rhymes. And right now, the rhyme scheme is getting very familiar. So here we are, standing at the edge of the same cliff we've fallen off before. Only this time, the cliff is higher and the rocks at the bottom are sharper. The next crash won't be contained to one country or one asset class. The shadow banking system is global. A crisis that starts with Chinese real estate debt or European sovereign bonds or US commercial real estate can spread through derivatives contracts to every financial institution on Earth in a matter of hours. And the tools that governments used to stop the last crisis, zero interest rates, massive money printing, emergency bailouts, are already mostly exhausted. Interest rates have been near zero for so long that central banks have less room to cut. Government debt in major economies is at peacetime record highs. The political will for more bailouts has evaporated. When the next crisis hits, and it will, the response options are limited. More money printing, which risks hyperinflation, austerity and defaults, which risk depression, or some combination, which risks both simultaneously. The nightmare scenario economists call stagflation. The system is built on an illusion, the illusion that infinite growth is possible, that risk can be managed and distributed, that complex mathematical models can predict human behavior, that institutions designed to extract profit will somehow act in the public interest when the crisis comes. But bubbles always pop, pyramids always collapse. Ponzi schemes always unravel, not because of bad luck or a few bad actors, but because they're mathematically designed to fail. They require constant expansion, endless new money flowing in, and reality always runs out of new money eventually. The tragedy is that we know this. We've known it for 100 years. Every generation promises they've learned the lesson. Every generation swears this time is different. And every generation walks straight into the same trap, dressed in the fashions of their era, speaking the jargon of their time, convinced that their bubble is based on real value and new paradigms. The Dutch had tulips, the British had South Sea stock, the 20s had investment trusts, the 90s had dot-coms, the 2000s had housing, the 2010s had everything, crypto, meme stocks, ENFs, SPACs, zero revenue tech unicorns. And underneath it all, the derivatives market keeps growing, the shadow banks keep lending, and the leverage keeps building. The people running this system know exactly what they're doing. They're not stupid, they're incentivized. They make their fortunes during the boom and walk away before the bust. They get bonuses measured in millions for taking risks measured in billions. And when it all falls apart, they know the government will step in. Because the alternative is social collapse. It's not a conspiracy, it's a business model. Privatize the profits, socialize the losses. It's moral hazard as a permanent feature of capitalism, and it's parasitic, extracting wealth from the real economy, from the people who make things and build things and serve things, and funneling it to the financial sector that makes nothing but claims on future value that will never materialize. So what can you do? Understand the game. Recognize the patterns. Don't let them gaslight you into thinking the economy is healthy just because asset prices are high. Asset prices are high because of leverage and speculation, not because of real growth. Protect yourself. Diversify. Hold some assets outside the financial system. Build skills and relationships that will retain value when paper wealth evaporates. And most importantly, demand accountability. Demand that the shadow banking system be brought into the light. Demand that derivatives be traded on public exchanges where regulators can see them. Demand that banks that are too big to fail be broken up. Because if they're too big to fail, they're too big to exist. The next crash is coming. Not because I'm a pessimist, but because the system is designed to crash. The only question is when and how bad it will be. Are we wiser now? Or are we just walking the same path in better suits? Drop a comment with your thoughts. Tell me if you see the same patterns I do, and if this opened your eyes to the machine behind the markets, Share this video with someone who needs to hear it. Hit that subscribe button, because we're going to keep pulling back the curtain on the biggest scam in human history. The truth is uncomfortable, but it's better than living in a dream that ends in a nightmare. Stay sharp, stay skeptical, and I'll see you in the next one.